So, Ridham, thank you for doing this and being a part of the Investor Hour series. I want to kick this discussion off by requesting you to share a little bit about your background, in the sense that where are you from? Where did you grow up? What kind of an environment was it? Ultimately, this is going to lead to what were the life events that led to Ridham becoming what he ultimately became. So if you could start with that, please.
Yeah, so I've lived all my life in Mumbai.
Okay.
Though I was not born in Mumbai. I was born in a rickety small town called Dahod, which is now, which is actually, it's colloquial. It's Dohad is the original name.
Okay.
Dohad means two boundaries. Okay. Because it sits very close to the boundary of Madhya Pradesh with Gujarat and Rajasthan with Gujarat.
Okay.
And it is now actually one of the 100 smart cities under the smart city program.
Uh-huh.
So, of course, it's come a long way. In fact, the Prime Minister just inaugurated a new locomotive factory with an investment of 20,000 crores. I think it was 2 or 3 weeks ago. So yeah, it's come of age. But back then it was. It's actually in a Adivasi area with a lot of Bhil population.
Very interesting.
So yeah, so that's where my parents came from, and that's where I was born, and I spent the first 3 months of my life there, and then
only 3 months.
Then I've been in Mumbai ever since.
Mm-hmm.
So I grew up in Mumbai, actually, in good old Bandra,
okay,
which is where I did my schooling, and then I went to Ruparel College for 11-12.
Uh-huh. That'd be a science college, right? Ruparel is
popular for science. I got particularly good marks in the 10th standard, which surprised everyone, including me. I was not supposed to be one of the rankers, but I apparently did get ranked across Maharashtra state. And then Ruparel College used to be one of those top colleges in those days. I don't know what its status is now, but that was everybody's aspirational college if you were a science.
I remember
student.
that, yes.
Yeah. My father had said, you do whatever you want in life, but just get an engineering degree.
Wow.
Because it will give you a lot of foundation. Foundation in math, foundation in logic, foundation in hard work.
Yeah.
So
hard thinking.
So so that's he himself was an engineer, so biased. But so I went to do science, and then I didn't do so well in my 12th standard exams. I was distracted by a lot of music.
Okay.
So I didn't study as hard, but I managed to get into civil engineering in Sardar Patel College of Engineering, which is right up here in Pawan's campus in Andheri.
Mm-hmm.
And that's where I did my civil engineering. Now, while all this was happening, back home, stocks was already being discussed because my father got introduced to the stock market in 1980. It was when the then which is a company which is now known as Tata Motors, but in those days was Tata Engineering and Locomotive Company, Telco, issued India's first convertible bond.
Did you say the year was 1980?
80 or 81. If somebody Googles on that, maybe I go wrong by a few months here and there. But I remember it was early 80s, and that's my first memory of anything to do with the stock market.
Wow.
Actually, that convertible bond instrument was brought to the market by none other than Nimish Kampani, with whom I actually started my stock market career later on. I'll come to that.
Yeah.
But he also brought the special premium notes, which were attached to the Tata Steel shares.
Mm-hmm.
I think sometime in the mid 80s. Those were all very unique products. They were never. In those days, the only thing that was in vogue in India was ordinary shares. Beyond that, there was nothing that traded. So convertible bonds, warrants, special premium notes, all these innovations happened in the 80s. And mind you, for those who don't know, in the 80s, the Indian capital markets were still governed or regulated, if I may use that word, by the CCI, the Capital Controller of India. There was no SEBI. SEBI came only in 1984, in the aftermath of the Harshad Mehta scam.
90. You mean 90?
1994. Sorry, 94. I beg your pardon.
Yes.
1994.
Yeah.
But prior to that, it was CCI. CCI's job was basically to determine or approve the share price at which companies could raise capital. And by default, it was always the par value.
Par value.
There was a lot of significance to the par value. Nowadays, nobody cares. Nobody even knows what the par values are. But because that was the base price at which you could make new issuances.
So 1980, your father was applying for these convertible bonds. You were, what were you doing those days? You were in college?
I was in school. I was in school.
Yeah. Okay.
I was 12 years old. I was in school.
Okay. And you saw that happen. Early education. Yeah.
No, by the mid 80s, he was more actively trading stocks, and I used to monitor them. In fact, my first stock market physical visit, if I remember correctly, was 1986. I was still a teenager then. I was into engineering, and his broker used to be, I think, on the 12th floor of the Bombay Stock Exchange. Kantila Lamtalal Shah. I know the name.
Wow.
I remember the name. I don't know which. I'm not very sure about the place. But if he's listening into this, then he'll probably remind me which floor his office was. So I started doing my rounds, and I got fascinated. Don't ask me why, but I got fascinated, and then I came across the Bombay Stock Exchange directory. I don't know if you know that was an 18-volume publication that the BSE used to have, which would contain, I think, 4 pages or so, 4 or 5 pages on every listed company on the stock exchange with a summary of financials and what the business was all about and things like that. And I actually managed to buy it. So I had the BSE directory, all 18 volumes. Each one of them was so thick. And it would probably occupy about, if I remember correctly, 8 or 9 feet lengthwise. And I started reading annual reports and started collecting them. I think by the early 90s, I had hundreds of annual reports collected, and I used to read annual reports. There was no other information access. Remember, there was no internet. The only other thing that was there was business magazines, but they were quite expensive actually.
And there were no quarterly results or half-yearly results. They were only annual reports.
Half-yearly
were there. Okay.
Yeah, half-yearly started coming. Quarterly, of course, came much later. Half-yearly had started coming. But things used to come with a lot of lag. Even share prices came with a lot of lag, because the share price feed, even during the Harshad Mehta bull run, the normal share price feed came on PTI, Press Trust of India feed. And there was 15-minute lag between actual share price and the feed that you got on the screen. There was a green ticker that would come, which would be the PTI ticker. And I mean, you could safely say that it was not the most reliable place to get share prices, because there was so much of a lag, and several times, share prices would be somewhere else. So if you were trading in small mid-cap stocks, you were almost virtually in the dark, because brokers didn't have the time to go to the patiya, as they used to call it, to fetch the price, the counter. Unless you were trading big volumes, and unless you went to the counter and checked with the jobber, you wouldn't actually have a live quote. And even that would change by the time he came back to his own phone and then called back from the ring down to the broker. There would be 3-4 minutes elapsed. I mean, imagine how the market trades today versus then.
Wow.
It was a very different situation.
That's right.
And then we had the seminal Bhav copy,
Hmm.
uh, which used to sell for 50 paisa, if I remember correctly. And there was a time during the Harshad Mehta bull run that Bhav copies were in short supply, and then photocopies of those Bhav copies would sell at a massive premium, like 4 times the actual price. And there were these guys who would stand on Churchgate station, handing out Bhav copies, and it
Mhm.
seemed to be the only place you could actually get all the prices that traded that day,
Exactly, yeah.
because the newspapers only reported a limited uh, number of
Yeah.
shares,
Mhm.
unless you went to the Economic Times. But then the Economic Times kind of cost similar, so
Yeah, yeah, yeah.
and
And
it
came
came
the
the
next
next
day.
day.
Yeah. Yeah.
Exactly.
So
So
along,
anyway, so
you also finished your postgrad along this whole phase when you were reading all
yeah,
the
so
annual reports and doing all the stuff.
yeah, so I did my engineering, and then it was already decided in my head that I want to be in the stock market. But just as a backup, I decided to go and get a master's degree in business management, or uh, well, it was master's in MMS, so Masters in Management Studies, a program hosted by the Mumbai University from Wellington Institute, because I didn't really get good marks in
Uh-huh.
my open test. I think I got 58 or something.
Hmm.
The cutoff for Bajaj in those days was in the 60s.
Okay.
So I couldn't get Bajaj. I had to go to Wellington. I got admission there, um, and I did this 2-year program, which coincided with the Arshad Mehta bull run. Because when I joined the program, India was on the verge of a BOP crisis.
Mm-hmm.
Um, the Gulf War was about to break out. In fact, the date is 1st August 1990,
Mm-hmm.
and that date got re-emphasized and kind of re-entrenched because of that movie Airlift.
Mm-hmm. Yeah.
People don't realize that the movie Airlift was around the whole Kuwait attack by Iraq, overnight on the 1st of August. And in that month of August, if I remember correctly, August 1990, we are talking about, crude oil prices more than doubled in a single month and brought India to its knees because we didn't have enough dollars to buy oil.
Mm-hmm.
So the economy was shutting down. We were also in the midst of a kind of a political crisis because the then Prime Minister VP Singh had resigned. Chandrasekhar took over as PM. It happened later in that year,
Mm-hmm.
and he lost he lost support of the floor in 3 months, and then he resigned, and India went to elections.
Yeah.
While it was in a BOP crisis, seeking a bailout from the IMF
Mm-hmm.
and World Bank, which is what happened when Narasimha Rao decided that he needed a apolitical person to run the finance ministry because there was a lot of heavy lifting to be done with these agencies
Mm-hmm.
with respect to the bailout, and that's how Dr. Manmohan Singh became India's finance minister. Um, and then, of course, he started off with this big budget in 91 March, which started opening. These were the conditions that were set by IMF and World Bank. They
Mm-hmm.
were not. They were not.
It was not our choice. We had to do it.
So I'll come to this later. But the only time in India's history since I've been following India's macro, say from the mid 80s, when we undertook reforms by choice was the period between 99 and 2004. And that was during the Vajpayee government. And now I see a return to that since 2019,
Mm.
when this government cut corporate tax rates. I have started feeling that these are these two occasions when we've undertaken economic reform by choice. Most times, India's political class lacks conviction about the merits of a market-oriented economy
Mm-hmm.
and is always oscillating between a market-oriented to a more centralized, controlled economy.
Yeah.
And we have usually defaulted to the latter rather than the former.
Mm-hmm.
So market-oriented economy was forced upon us by the IMF and World Bank, which was obviously godsend in hindsight because it just changed India's future.
Yeah.
As we opened up our markets. The average import tariff in 1991 Again, check me on this, but it was 108 or 9%.
It's probably right.
And today it's a single digit number.
Wow.
So everything that corporate India did in 1991, in terms of production, in terms of where they sold, in terms of what price they sold, was controlled by the government. How much cement you produced was determined by the government. To whom you sold it was virtually determined by the government, and at what price as well. Which is why a lot of these commodities had, often had very flourishing black markets, because supply was so restrained. But suddenly in 91 and 92, everything was dismantled. And we also started allowing foreign investors to invest in the equity markets in Jan 93. So a lot changed for the stock market. While of course everybody has probably seen the serial scam and the bull market in that period. By the way, from August 1990 or later date, no, I think from the middle of 91 to March 1992, okay, 9 months, the Sensex more than quadrupled.
Wow.
Okay, any bull market after that pales in front of what I had witnessed with my eyes then. Wow. Okay, the Sensex went from circa 900 to 4,500 in less than 12 months. It was unprecedented. I mean, the way share prices went up, it was crazy. And of course, later on, we found out that it was because there was a lot of bank money that was getting fueled into them, getting funneled into the market. But when you look back, and of course, the stock market, if I remember correctly, and I'm sure the street doesn't have the data anymore, but I was collecting this data. It was trading at 50 times earnings at the index level, okay, at the peak. So the Sensex EPS was, I think, around 90, and it was trading at 4,500. Okay, so it puts into context the 33 times Nifty multiple at the peak of 2008. Add another 50% to that.
Then you get the
and you get the 92 bull market peak. Add about 2.5 times to current market levels approximately, and you get the P multiple of what you had in March 92. So obviously there was exuberance, no doubt about it, but it wasn't completely out of place because India was going through disruptive change, which would forever alter, cash flows for corporate India. And I remember we at Morgan Stanley do an annual investor summit for institutional investors, and we started that in 97. We're now, I think, in our 26th year. I remember writing the preface for the 2003 event. India's total market cap was $90 billion. Okay,
$90 billion.
Yeah, in 2003. We're now at 3.5 trillion. Okay. So what happened was that we went through this very prolonged bear market from 92 to 2003. Of course, there was a NASDAQ-led
and 94 bubble. Also, I think India had a 94 peak because of the FII money coming in, if I remember. It
didn't. If I again, we can check the charts, but it didn't cross the 92.
Yeah, it was around 44, 4,500 something.
It came within kissing distance of 92, but didn't actually cross 92. We did cross 92 in Feb of 2000. Largely led by the new tech
TMT stocks.
But actually, if you X out the TMT stocks, the rest of the market was still in a bear phase. And that bear phase only ended in March 2003. So give or take, I mean, of course, if you start nitpicking, then you'll say, no, we had a bull market between 98 and 2000. But largely speaking, the broad market went through a near 11-year bear market that started at the peak of 92. And therefore, a whole generation of equity investors got wiped out. Okay, which is why domestic retail did not participate in the 03-07 bull market. It was largely foreign participation. Most domestic, when I say, I don't mean the smart, savvy domestic investors,
masses,
but the broad class of investors did not participate. They missed it. Very unlike today's situation where they are participating in the ongoing bull market and in fact participating a lot more than foreign investors who seem to have lost conviction on India. So anyway, circling back to the original point. So yeah, I finished my MBA in 92 and then we saw this whole thing happen. And then I joined JM Share and Stockbrokers in 92 June. Because
that was
I wanted
straight out of college. Straight out of college.
Yeah, straight out of college. Yeah. I wanted to work for one of the Nimishes.
Yeah.
So one side was Nimish Company and the other side was Nimish Shah.
Yeah.
But Inam did not turn up at the college interviews. And on the fifth day, and by the way, I later on got the gold medal from the Mumbai University. So I topped the university for my MBA, but I was still unemployed on day 5. Because I was waiting for a stockbroker to turn up with an equity research job, which by the way
you were passing by all the jobs that were coming, waiting for a stockbroker to come. Wow.
Yeah.
You were so sure.
No, I wasn't sure. I was so sure of what I wanted to do. I wasn't sure that I ever get hired.
Right.
But I got lucky. I got hired. Of course, they decided to pay me about 25% of what the batch average salary was then. So it was a very small amount of money, but it didn't matter because I got exposure to capital markets.
Do you recollect what the first paycheck was at JM?
Yeah, of course. Should I say it?
5,000, 7,000, 10,000?
1,800.
There you go. To all those who are listening, and those were the salary levels in 1992.
No, they were not. Their salary
a little bit, in that range, ballpark.
If I remember correctly, my batch average was 7,000. There were people who came in at 10,000. I was at the bottom at 1,800 because it wasn't the highest paying job in those days to do equity research. In fact, nobody knew what equity research was when I arrived. I started from scratch and I had a little bit of a background, but I learned everything along the way.
But JM, even then, JM had a long history, right? Decades. Even by the 90s, they had been around for decades, right? And you were moving into this, effectively a blue chip of the stock market in terms of pedigree. How was that like?
Yeah, but equity research was not the big thing.
Yeah,
because they were, because Nimish Bhai was mostly into investment banking.
Okay.
So broking was his father's business, which of course was there, but it wasn't his bread and butter was investment banking. So yeah, I went to the broking business in the equity research department, and then things started changing. Along the way, 18 months into this, I got a bit of a entrepreneurial bug, and then I joined Alchemy. And 3 years after that, I kind of thought that, this is not my cup of tea. I need to go back into doing this more professionally and on a professional basis. And so I rejoined the industry in UBS. And I was a year at UBS, and then Morgan Stanley made me this job offer, which I am still holding on to, which was about now coming up to 25 years ago.
Yeah, that's a big run. And we'll talk about that in a bit, but didn't JM have a joint venture with Morgan Stanley? So is there any connection?
Later on. So I left JM in the post Diwali 1993. And then in 1999, 6 years later, it became a full circle because then Morgan Stanley went into a joint venture with JM. So we became JM Morgan Stanley with two different companies, one into investment banking and one into equities.
Okay. So do you recollect what was your first investment? Where whatever it was, be it stocks or metal or whatever?
It was stocks only. I was already investing in my father was very kind, he would let me take decisions. And so even though I was still learning about it, but I think that helped me a lot. And especially in the 1991 bull market, he somehow trusted my instincts. And so I was basically buying and selling stocks then already. So I can't quite recall which was the first security. Really, I know a bunch of securities that I traded in, but I can't quite remember. Apart from stocks, I've not traded anything else in my life.
Did you ever
So
did you buy anything and hold on to it as a like a long-term investment, or you
I
were
didn't
more
have the
yeah,
I
didn't
didn't
have the
have the
capital?
capital. We didn't have the capital then to do that. So what the 92 bull market did was create capital.
Hmm.
So uh, so I was speculating a lot. I was hugely levered, and I paid badla rates all the way into three digits, 110, 120% on my forward positions. I don't know how many people here know about badla rates,
Yeah,
but
I think you should. Why don't you explain? It's it's a nice piece of history because
yeah.
I came to
So we had
Bombay.
a
I came to Bombay in '94 to study, right?
uh,
And I would go and get the bhav copy just out of interest. And the badla rate was very closely tracked, right? It was the ultimate
yeah,
indicator of so many
yeah.
things. Just tell us
So
what was badla. Yeah.
so pre SEBI, the Mumbai stock market had everything.
Mm-hmm.
It had a forward market, it had an options market. So essentially, it had a futures and options market, but they were all off the official
Of the screen. Yeah.
trading. Yeah, so they
Of
used to happen as on the curb, right? Curbside, right? Khangi was the word that was used. Okay,
okay.
curbside.
Mhm.
Actually, trading continued well into the evening on the curbside, and the large cap stocks could always be bought post market,
Okay.
and then the trades would be ratified the next day. Because remember, the market only traded between 12 and 2.
2 hours a day. Yes.
Yeah,
Mhm.
and but there was trading that happened in the morning and post 2 o'clock as well on the
Mhm.
curbside. So
Mhm.
so that was the then prevailing practice. But yeah, badla is basically the interest that you paid on your forward trades, because there was Group A and Group B stocks. Group A uh, were the stocks in which you could carry forward your transactions on the expiry of the settlement period. The settlement period then used to be 2 weeks. So within that 2 week period, you could do whatever you want. You didn't have to settle. But
Mhm.
at the end of the 2 week period, you had the option to settle via cash or stock, depending on which side your trade was. If you were buying something, you would settle with cash. And if you were selling something, you'd settle with stock, or carry that trade forward into the next settlement period. And for which you would then, based on a settlement that would run on a Saturday morning, there would be a badla charge. Basically, the finances of your transaction would be paid off. They would either be financing you with money to carry forward your buy trades, or with stock to carry forward your sell trades. Typically you would receive badla for providing stock, which is short selling,
Mhm.
and you would pay. But of course, that would again depend on the market
Yeah.
cycle. And
Yeah. Yeah.
the market was very bullish, and the badla rates, annualized badla rates, were in three digits. Um, so I got lucky. I managed to exit the day after the Sucheta Dalal article
Mhm.
on. Sorry, the second day after the market opened. Her article, I think, was on 21st or 22nd of April, and the market reopened on 28th, because brokers were on strike in protest of the government's proposal to put SEBI into place.
Mhm.
So SEBI actually, yeah, when I said 94, I should have said SEBI came in 92, not 94.
Mhm.
And then I think 29th April, I managed to get rid of stock. So I exited very fortunately, luckily, with some profits. And that was the
Wow.
first capital that we built. And then it got preserved, because I was not in the downturn. The index went from 4,500 all the way down to 1,900 before it troughed out, and before the next teji wave started with foreign investors.
Do you recollect how much trading used to happen those days? What is the size of the market? And
You mean daily traded volume?
yeah, do you recollect?
No, I don't. I have it in a file with me, but I don't remember
Yeah.
the number.
That comparison would be very interesting, right? Probably
Yeah, but
100 crores a day to,
but I gave you the market cap comparison in '03 when
yeah,
the
yeah.
Sensex was at 2,700,
Mm-hmm.
and the market cap was in two digits. It was less
90
than
billion.
$100 billion.
Yeah.
Yeah. So this may not be very different. I mean, at 4,500 index, the market cap may have been higher, but not materially
Okay. Yeah.
higher. So traded volumes would, I think, as a percentage of market cap, would be actually quite less compared to today, because now the market has become far more broad based. And I mean, the reforms that say, just a word here, the
Mhm.
reforms that SEBI undertook through the 90s and the first decade of this millennium are seminal in nature.
Mhm.
And it often, I make this comment to foreign investors that India's financial markets are almost at par with any financial market in the developed world.
Mhm.
Even though so financial market infrastructure is at par, but physical infrastructure may be 30, 40 years behind.
Mhm.
Um, because a lot of foreign investors who don't know India think that our physical and financial market infrastructure are similarly aged, but we are not. Our financial market infrastructure is very advanced.
Yeah.
And it's largely because of the really difficult things that SEBI managed to push through in those years.
Mhm.
There was a lot, because the Bombay Stock Exchange was a coterie of brokers
Mhm.
who controlled it. It was a club, right? And to break that and to to create the type of market infrastructure that we have since created
Yep.
is quite a
We take it.
incredible thing.
Yeah, we now take
We
it for
take it
granted. Yeah.
exactly. And we did suffer some of our learnings along the way, some of our shocks,
Yeah.
some of our scams, but each of them has led to a response and a change which has made the market a lot safer.
Yeah.
See, there are two types of risks in the market, right? One is, of course, price risk, which is
Mhm.
unavoidable, because
Mhm.
the minute you are in financial markets, you always bear price risk. But then the other risk, which is non-price risk,
Yeah.
one which you get scammed, or a broker runs away with your stock,
Yeah.
or you don't get paid money by
Or you remember
somebody.
you used to get those transfer deeds. There'd be a
Yeah,
signature mismatch. You'd never
I
get the
still
share.
have I still have some shares which remained in physical because I could not get the Vanda, as they used to call
Yeah.
it, settled.
Yeah.
Okay, so signature mismatch was a very common thing.
Yeah.
Not only that, physical share certificates were stolen. I was also subject to one such episode where, in transit, my share certificates got stolen,
Wow.
and the person who stole the certificates transferred them to someone else.
Whoa.
And then I went to the company to say that, how did you transfer this, because there's no way the signature would have matched.
Hmm.
And really the company had no answer to this. And so a lot of these things are now not so. Non-price risk is close to zero,
Yeah.
because of all the massive reform that we've had in the last 20 years or so.
So you mentioned your father was trading in the 80s. You were trading and kind of building capital, if you will. You're at heart, who's Ridham? Are you a trader? Are you an investor? Do you do both?
No. Now I am only an investor. I actually recommend to people not to trade.
So which was
I,
your
and,
first investment? Tell me your first investment. So
uh,
forget the trading days, whichever you can recollect along the way, a stock where you said, this is, or whatever asset it was. That this is
so
what
I would hesitate to go into individual names, but
yeah.
it was a mid cap company, which I still continue to hold. Um,
How many
so
years did you hold it?
yeah, I'll tell you. So most of these investments happened post 93. So
Okay.
when the markets corrected in 93, I started investing.
Mm-hmm.
So I still hold on to all those investments. We are what now, almost 30 years, and these companies are now paying me dividends which are greater than the price at which I bought those shares. So my dividend return on initial investment is in excess of 100%. I
100%.
get my capital back every year, and and it's been happening for quite a few years because these companies have grown. Uh, you can only experience the miracle of compounding over that time frame.
That's right. Mm-hmm.
Any shorter time frame and compounding doesn't happen. You
Mm-hmm.
may get lucky sometimes. Stock prices can do funny things, and they can go up 5-10 times in a very short span of time.
Mm-hmm.
But real wealth is only created via long-term investing. And I keep telling people that you'll hardly find any trader who has become wealthy. You'll find many investors who have become wealthy, because all the money that investors, all the wealth that investors make comes from all the wealth that traders lose. Right? It's
Yeah.
a zero-sum game in
Yeah.
the market. I mean,
That thought is worth repeating. Can you repeat that once more?
Well, yeah, well, it's a philosophy. It's not
Yeah.
really mathematically
Yeah.
provable, but all the wealth that investors make comes
Mhm.
from the wealth that traders lose.
Mhm.
It's very hard to take away money in trading. Um, you kind of lose money in the end,
Mhm.
unless you get lucky like I did. But investing is very hard to lose money
Mhm.
unless you're really bad. And in fact, uh, I think the most difficult thing in the market is to stay tight and do nothing,
Yeah.
and that's where the money compounds.
Yeah. It's,
Which is why not looking at stock prices is a very
yeah.
very good thing.
Yeah. Warren Buffett's been saying for years, he sits on stock and cash. He was sitting on $150 billion all these years,
Yeah.
didn't do a thing. And now look how he's
Yeah, so
doing.
Rahul, the thing about the reason why equity investing is difficult is only because of this. Is that you see live prices, and live prices have a massive psychological effect. Like look at the market of the past few days.
Mhm.
It's so difficult for people to just sit there and do nothing,
Mhm.
right? Most people would think that, let me get out of this because this is going to go down another 10-20%, and I'll come back at a later stage. And if you do that, invariably, you're either going to be out of it
Yeah.
and never come back,
Yeah.
or you're going to end up making a mistake. So the more often you trade, the more mistakes you're prone to making.
Mhm.
Because in any case, there's an element of luck involved here.
Yep.
I keep giving this example about how do you determine the quantum of luck in any activity. So the quantum of luck is determined by how deliberately you can fail. So think about a carpenter trying to build a table. It's very
Mhm.
easy for the carpenter to fail. All he has to do is to cut one leg short, and the table will not stand properly, and he has failed. So it's 100% skill job. It's a 0% luck job. There is no luck required in
Mhm.
carpentry.
Mhm.
If you move the perspective to say cricket and somebody deliberately trying to get out, in most cases that person will succeed. There will be these occasions when that person will not succeed.
Mhm.
So there's an element of luck, but cricket is still largely a game of skill. Exams. This is a very good one. Can you deliberately fail at exams? 100%.
100%. Of course.
Because all you have to do is go to the paper and not answer any question.
Mhm.
You give a blank sheet back and you
Yeah.
will
Yeah.
get 0
You will
marks. You
fail. You're
fail.
not going to pass. Yeah. Yeah.
So the role of luck in exams is zero.
Mhm.
The
Mhm.
reason why people think there is a role of luck is because they don't go fully prepared.
Mhm.
Because they use they use probability to decide what pages they're going to skip.
What to study? Yeah. Yeah. What to
Yeah,
study? What
and
not
that
to
is why
study?
that is why you expose yourself to luck. But
Mhm.
in stock market trading, not investing,
Mhm.
try losing money deliberately. I've run this experiment with my team members over the years, and invariably, most people come up and say, I am very, very sure this stock is going to go down in the next 2 months.
Mhm.
And 2 months later, the stock has gone up.
Mhm.
Most people fail to lose money deliberately in the stock market on a trading horizon.
Okay.
Um,
Uh-huh.
so that is the problem with trading, is that you get exposed to luck, and that's why it is so much harder to win that game
Mhm.
versus
Mhm.
investing, where I think you disintermediate luck as soon as you extend your time horizon and take it to longer horizons. And then if you've done due diligence and if you have invested at a reasonable price, then I think you will come out good.
Yeah.
So you
So,
buy
yeah.
companies with reasonable people and a reasonable business and a reasonable price. You don't actually have to buy the best companies in the world at the lowest prices. That's not required actually.
Give it time. I guess that's the biggest differentiator, right? If you do, you can buy the right company at the right price with the right management. But if you don't give it enough time, and if you're seeing the live prices, you're in trouble. But if
Yeah.
you can be like all the investing greats, if you just sit on it and allow them to do their thing, the probability of you succeeding just keeps growing with time, I guess.
Yeah, that's why I think this ongoing boom in systematic investing is such a right thing for investors to do.
Mm-hmm.
Because if you invest every month, you disintermediate yourself from any particular price.
Yeah.
And if you hang in there long enough, the results will be quite good.
Mm-hmm. Yeah. Yeah. So, what's your approach to investing? And I'll tell you why I'm asking you this. A couple of years ago, or a few years ago, when we spoke, you spoke a lot about momentum. I don't know whether you recollect that. You mentioned about that you're starting to study, or you're starting to see merit in momentum. So I'm just trying to understand from you, what's your preferred approach of picking a stock?
So the momentum conversation would have happened in some context, which I can't recall now. But the thing is that if you look at various style factors in the market, momentum is a persistent winner.
Mm-hmm.
And the logic behind that is that something that's winning continues to win until it stops winning.
Yeah.
So there can be very sharp reversals in momentum.
Mm-hmm.
But if you put it into a basket of stocks,
Mm-hmm.
okay, with the highest momentum,
Mm-hmm.
all may not fail at the same time. And these are some of the inefficiencies that exist in the market. Since we all think, we are all rooted with this efficient market hypothesis.
Mm-hmm.
The markets are not efficient because the fact is that the assumptions that we make in theory don't actually work in practice.
Mm-hmm.
So markets are far from efficient. Having said that, the price is still king, and the markets don't go wrong very often. They are right 90% of the time. So if you disagree with the market, you need to go back and check your own assumptions. And you have to be very, very sure that you want to disagree with the market. Because usually the market, is consisting of, the inputs from multiple number of people running into hundreds and thousands of people, and doesn't get it wrong. If I look back on the last 30 years, the market got it wrong in the Arshad Mehta crisis. It got it wrong in the NASDAQ bubble. It was wrong in 2007-8. And that is about it.
Mm-hmm.
Okay. It may have been wrong in 2003, but you'll see all these are major inflection points.
Mm-hmm.
On an ongoing basis, the market doesn't get it so bad. As we, when we express opinion, tend to believe.
Mm-hmm.
So that was, I think, the context of momentum. Investing style, I think you're looking, as I've already revealed that, you're looking for reasonable businesses.
Mm-hmm.
Obviously, you want to have a business with a reasonable moat, but no moat is permanent, and moats will come and go. So you have to keep a constant watch on that. You want to buy businesses with good people behind them. I think that's the most crucial one, because ultimately, if the people are not good, then good votes will also waste. And if the people are not good, the chances are that you may suffer from poor governance. Price, I'm not so fussed about price actually. It's something Charlie Munger actually, I think, taught Warren Buffett.
Warren Buffett, yes.
Because Buffett came from the Graham school. He was actually a student of Benjamin Graham. But Benjamin Graham's era was post-depression, where cigarette butt investing was absolutely possible.
Yeah.
There were stocks that were trading less than the net working capital on balance sheet. Today, I don't think you'll find such mispricings anywhere in any market in the world. So it's so hard to deploy large amounts of capital if you're looking for such mispricing. Maybe small amounts, you'd still be able to do it, but you'd hardly get market caps which are less than net working capital. Okay. It happens sometimes, but you'll have to be very, very patient. And then, as I have observed, when stocks are trading at so-called deep discount to assets on balance sheet, usually there's a problem with the business.
Usually the value traps, what they call in technical language, right?
Exactly. So it's not like you're getting stuff free. So it goes back to the market is pretty good at discounting stuff. So it doesn't throw opportunities every now and then. So price, I'm a little less fussed about. But of course, if you're paying too rich a price, then you have to be prepared for. No, you have to be prepared for suboptimal returns for a while. Because the market will, the earnings or the cash flows will have to catch up with the price.
So this is what Buffett says now, right? it's better to pay a fair price for a good company than to pay a good price for a fair company. The world has changed, right?
Yeah, that's the Munger.
Yeah, that's what Munger taught him. That's right. Yeah.
Yeah. That's what Munger became his partner. That's what he changed in Buffett's thinking. Buffett returned capital, I think, in the late 60s.
Mhm.
I don't know if you've read this book by Ed Thorpe, his biography. Um, in that, he refers to this dinner that he had with Warren Buffett, who had just returned capital to shareholders.
Okay.
And after that dinner, Ed Thorpe tells his wife, this guy that we just met, he's going to become the richest man in the world. He's that smart.
Wow. Mhm.
So, of course, that time Warren Buffett was not known to anyone. But when Charlie Munger came in, I think he shifted his thinking process. Now, price, what is price? That is, I think, something that we need to understand,
Mhm.
because most people think that valuations are, P ratios and price to book. But, I keep telling people that price to earnings and price to book is nothing but price itself. So you can quote the share price of a company in absolute rupee terms. So this is 1,000 rupees, or you can say it's 15 US dollars, or you can say it is 20 times earnings.
Mhm.
And there is no information contained in any of these three, of
Mhm.
which is of value to me.
Mhm.
Whether you say it's 20 times, earnings is just a currency like rupee and dollar. It is not an indication of valuation.
Mhm.
Valuation is only when you are able to assess what the future cash flows will be and then discount them at your expected rate of return. And that's when you arrive at value. Now, it's complicated, it's difficult, but it's not impossible. And the approach that I have is to figure out what's in the price rather than try and assess fair value. So let's see what the share price is currently telling me about where future cash flows are going to go. And if those future cash flow
Mhm.
assumptions embedded in the share price don't look outrageous, then I seem to be buying some business at a reasonable price. If they look outrageous and they look like, the company's cash flows will exceed some benchmark that you may have in, say, 5-10 years, then of course you are not buying it at a reasonable
To,
price.
to a traditional value investor, that's like committing harakiri, right? You're working it backwards and seeing whether the price is telling you something and that something is actually reasonable, right? I
Yeah,
think the
but
typical value investor would stick to his own standard principles and then come to a price and then say, okay, market is 10% high, I'm not going to buy it.
no, but it's the same thing. So no, I don't think it's the same thing. It's value investing. It's a easier approach to estimating cash flows.
Mhm.
Estimating cash flows can be subject to a lot of errors.
Mhm.
Whereas uh, figuring out what is implied in the share price is subject to fewer errors.
Oh,
So I think it's the same thing in my view. It's not different actually. It's
Mhm.
just the
Mhm.
approach, yeah. And of course, you want to focus on businesses that are generating return on capital on a sustainable basis above cost of capital. Because if that's what they're doing, then they will not come back to you to raise equity.
Mhm.
And
Don't
usually
agree.
those share prices tend to do the best in the long run. Businesses that need to raise equity capital from their shareholders to grow their businesses, eventually struggle to deliver superior returns on capital.
Mhm.
So I think that's a straightforward approach. It's not so straightforward as it seems. Now, in the midst of all this, I must say that macro and politics play a pretty big role,
Mhm.
which
Mhm.
sometimes a lot of stock investors tend to ignore. But macro and politics can alter a business's future very quickly without notice. And therefore, I think stock market investors need to have a keen eye on the macro and the politics.
Mhm.
For example, right now, there was a seminal shift in the government's policy in September 2019. Hitherto, for the previous 13 years or so, we were pursuing a policy of lifting share of wages in GDP, with the idea that higher wages will trigger higher consumption and higher consumption will trigger higher growth. But we were not getting that result because we were essentially we ran up high inflation as a consequence. And then to curb inflation, we kept real rates very high. In 2019, the government said, let's switch this and go back to where we were in 1999, which is let's try and lift the share of profits in GDP. If we do that, companies make more money, they will invest. When they invest, they'll create jobs. When they create jobs, they'll create wages. Wages will flow back into consumption and into more investments, and we will get more sustainable growth. Now, such a shift in policy has got huge implications for capital owners, which is basically people in the stock market, because suddenly the government has said, I am now going to favor you over the labor class. And that is exactly what happened, which is why India has done so well through the pandemic on a relative basis, and continues to do well on a relative basis, despite so many upheavals that are taking place in the world. I mean, India is amongst the best performing stock markets this year. And if somebody had said at the start of the year that, we're going to get a war in Ukraine and oil prices are going to jump up like this, and what do you think? Most people would have said Indian stock markets is going to go down, but they didn't. Of course, there are other reasons as well, but there is a shift in India's policy approach. So policy plays a pretty important role. Governments can destroy profitability by moving import tariffs or changing export duties or other policy decisions pretty quickly. And so I think I find that in my normal conversations, not with institutional investors, but with individual investors, there is a lack of regard towards policy and politics, which in my view play a pretty important role. For example, I'll take you back to 1980, when the US was facing hyperinflation, and their Fed governor, Paul Volcker, against all advice, decided to lift short-term rates into double digits. And that completely altered inflation dynamics in America for 4 decades, and started a wealth creation campaign, which has been unmatched in the history of the world. And of course, I'm simplifying all of this, but there were a lot of other factors. But the then President Ronald Reagan also did another thing, which is he allowed 401k plans, which are retirement plans, in the US to invest in equities for the first time. In 2015-16, we went through very similar shifts. We had a new legislation which mandated the RBI to target inflation and run positive real rates, and we also had the government allowing Provident Fund and National Pension Scheme to invest in equities, which was not allowed until then. And that's changed the dynamic of domestic risk capital totally. The risk capital that's coming from domestic sources today is an outcome of these two policy decisions that happened in 15-16. So all analysis of company level cash flows has to be done in this backdrop.
Yeah, it's I like the way you're explaining it to us, and you're telling this as you're able to explain it very well to us. But I hope the viewers and the listeners are getting the impact of this, because when you talk of a mindset shift in the government from pushing wages higher to actually becoming pro-business, and the trickle-down effect, if you will, right? When you talk of investing in equity, when the whole decision was taken that a Provident Fund could invest in equity, there was a little bit of noise, and I think people forgot. Right now, I don't even think the newspapers are quoting how much money is going, or maybe they quoted once in a year or something. So you mentioned something earlier in the podcast, and you said that India's reforms were thrust upon us, but only there were phases. One was the Vajpayee years, and one are the recent years, where we are doing something deliberately and trying to move forward. Given all this context that you see and all these big changes that you're talking about, how are you looking at India from a 5, 10, 15-year perspective? How do you see us doing in the next 5, 10, 15 years?
I am very bullish, because I think we have found a few solutions which I think will go a long way in fixing this country's problems. So let's talk about the pyramid. So India suffers from a very bad pyramid, which is we have very, very many poor people at the bottom of the pyramid. some estimates are that 1/4 of this country's population does not get a dinner. Okay, I don't know the exact number, but there are some estimates. So it's, we have some of the poorest people on the planet. Okay, forever governments have tried to service this lot by distributing free grains, by distributing free stuff.
Yeah.
It never reached them.
Mhm.
Because from the top to the bottom, there are scores of middlemen who basically extracted their commission, and what reached the bottom was always very little. And as a consequence, we did not make much progress, and we wasted a lot of taxpayers' resources through the years. I had done some calculation a few years ago. In the preceding 30 years, we have spent $500 billion in subsidies.
Wow.
And frankly, I don't see it in
No impact.
economic progress.
Mm-hmm.
The Aadhaar, technology has totally changed it.
Mm-hmm.
And when Nandan Nilekani worked on it, I don't think people understood its implications.
Mm-hmm.
But today we have the direct benefit transfer program, which is done through Aadhaar, which has, I dare say, reduced leakages in government social programs by a factor of 99%. And as a consequence, a lot of the taxpayers' money now is reaching the people that ought to be receiving it. Now, in the aftermath of the depression, Kenneth Arrow, a famous US economist, had said that if you're trying to, and I'll give you the example of Usain Bolt. Okay, so if you're trying to run a 100-meter race with Usain Bolt, there's no way you're going to win that race.
Mm-hmm.
Correct? But if someone says, okay, you do the race, we'll put you 30 meters ahead of Bolt.
Yeah.
You're still going to lose.
Mm-hmm.
Okay, Bolt is going to beat you, but you're going to have an interesting race.
Yeah.
Right. Mm-hmm. So that is the idea of social welfare, which Kenneth Arrow had come up with. Okay, mm-hmm. Even in a pretty determined capitalist society like the US, that there are a few people who are disadvantaged because they are just born in the wrong place at the wrong time. And how do you create equal opportunity for them? Mm-hmm. And I think this is, what we are about to see. More equal opportunity for people in the country, at least in terms of access to economic resources, mm-hmm. via government transfers. And this could have a seminal impact on India's future. So that's one. The second thing is, I think the geopolitics globally are shifting, because India is, arriving at the stage now with a very large economy. At the end of this year, will be the world's 5th or 6th largest economy. We would have overtaken Britain. Mm-hmm. We just overtook France, so we'll be 5th. And in the next 3-4 years, we'll go into the top 3. So it's not a small economy anymore. We sit in a situation where a lot of the Western Hemisphere wants to be in alliance with us, mm-hmm. and that changes, the importance that India has in the power ladder, mm-hmm. and it has a huge impact, because what will happen in the next few years is that a lot of companies will want to set up manufacturing facilities in India. We're already seeing this big services boom that's taking place because companies want to outsource stuff to India, and India as a consequence will accelerate in terms of growth. Yeah. So when I join these two things, I think we are looking at a pretty, and then of course the natural progress that we are going to have as a consequence, mm-hmm. of the change. Yeah, the changes that have anyway taken place over the last 30 years. Yeah. They should not be underestimated by any stretch of imagination. I think you add all this up and the future looks very bright. No doubt there are risks out there. There are plenty of risks. There are always, mm-hmm. risks. We have geopolitical risks on our border. We have the potential of political uncertainty. We have other risks, like oil, while we transition away from oil. And all those risks are there, and that will produce volatility along the way. Mm-hmm. But there's a fair chance, I think, that we will arrive in the next 10, 20 years as a much larger economy and a much larger stock market than we are today.
Yeah. You spoke a little bit about risk. So what keeps you up at night? What worries you the most?
Nothing keeps me up at night.
10, 15 years, all looks good. Huh?
No, no, nothing. Why should I get bothered by these things? But anyway, so
Good
for stock
prospect.
market, stock market investors, there are always going to be risks, and there
Mhm.
are always going to be unknown factors, and I'm not going to be able to explain those because I don't know them myself.
Yeah.
Right? How do I know what risks are going to come? But I can kind of guess. What I think is that what I'm guessing is already known to people.
Mhm. Mhm.
So but they could come up and play around and create volatility, which we have
Yeah.
seen in the past. So risks are always going to be around. They'll never go away. That's what stock market is. I think Knight Frank, I think it was in 1920 or
Mhm.
1921, he has written this super book on uncertainty versus risk.
Okay. Mhm.
And in that, he has said, what is profit? So I will not go into uncertainty versus risk, which is technical in the sense that risk is something which can be quantified. Uncertainty is something that cannot be quantified. Simple. Okay.
Mhm.
So you can attach probabilities to risk. You can't to uncertain because it's uncertain. What is profit? So profit comes from uncertainty. So
Interesting. Mhm.
there are entrepreneurs who are willing to deal with an uncertain future, and when they succeed in that, they generate profits.
Ah.
So if I took away the uncertainty, there will be no profits left. So uncertainty has to be there. Risk, I'm not going to use the word risk because Knight Frank will say risk is something you can arbitrage. Okay,
Mhm. Mhm. Mhm.
risk is something that the option markets actually will give you a price for,
Mhm.
and you can
Mhm.
actually offset that. But uncertainty is not something that the option markets will ever be able to price, and
Interesting.
profits only come from uncertainty. So it is but natural that there will be uncertainty. You need it. The day you feel that there is nothing uncertain, you rest assured there is no profit left.
Yeah. So nothing to lose your sleep over for sure. Okay. You spoke of a lot of names. You're obviously very well read. You've seen all this stuff. Is there any person, individual, investor who you really admire and who's had a big impact? And if you can probably share, what was the impact and how it's helped you?
See, lots of people actually. I think we'll run out of time. But amongst the contemporary people, Naval Ravikant, I think, is one
Mhm.
of the smartest guys on the
Yep.
planet.
Mhm.
So he's certainly somebody that I try and stay in touch with his views.
Mhm.
Nassim Taleb is another one he's another smart guy.
Yeah. Mhm.
Um, and I think he's somebody you want to track. Of course, now Charlie Munger is giving fewer and fewer interviews, but whenever he drops his word of wisdom, you want to catch on it
That's right.
because he's back home. We have some really smart people. I think Nimish Shah.
Mhm.
I think he's the quintessential investor that everybody wants to be.
Mhm.
Long-term, really long-term investor, very fundamental.
Mhm.
So, but again, unfortunately, he never does any press interviews. So
Mhm.
I think the last time he did a press interview was in December 1991.
Oh, really?
Yeah, I think he doesn't. But if you get the good fortune of interacting with him, then I think it is
Wow. Yeah.
his entire team. I think is really right up there in terms of
Mhm.
investing. No,
Mhm.
there are I'd actually be unfair because I'm
There's so
sure I'll
many.
leave
Yeah.
out leave out names. There are so many people who drop with pearls of wisdom along the way.
Mhm.
There's no dearth of wisdom out there.
Mhm. So,
But
so
but the but the thing is that you have to create your own wisdom, because if it was all contained in books, then we'd all be very smart, and there'll be nothing to do after that. But the fact is that books, do not really impart wisdom. Only experience does.
experience does. Yeah, that's well said. Okay, here's a scenario. So you're married,
Mm.
right? So we've been through a lockdown, and your wife's been probably saving up all the cash, etc., etc. And she comes to you and she says, "Hey, Ridham, I saved 1 crore rupees over these last couple of years. What should I do with it?" What would be your advice?
Spend it.
Spend it on handbags, on shares, on gold, where?
No, see, my instinct is always, invest in equity markets. I'm
So,
an equity guy. I don't do anything other than equities.
so you're, so yeah, that's something that does that preclude other alternate ideas, or do you believe that this is the best idea and that's why you are equity
See,
market?
there's some research out there which says that in the long run, a cockroach portfolio works the best,
A
and
what
that's
portfolio?
cockroach portfolio.
A cockroach portfolio. Okay.
Yeah, so I don't know if you know,
Not the
but
best imagery, but yeah.
the cockroach is one of the most versatile
Survived
living
the
forms.
longest, right? So, yeah.
Yeah, a cockroach can live off the gum on the back of a stamp. Okay,
Okay.
and cockroaches may not die in a nuclear attack. So they're pretty resilient, okay, like crocodiles. They're amongst the oldest living things on this planet. So they have some ability to survive. So that's why cockroach portfolio. Does it have ability to survive?
Right.
So that is usually 25% equities, 25% gold, 25% bonds, and
Real
I think
estate, 25% real estate.
no, I think 25% cash. Okay.
Cash.
So yeah, so
So
that's how.
stocks, bonds, bullion, cash.
Yeah, because it should be tradable, right? Property is not tradable.
Yeah.
So that's why, yeah. So property is a separate thing. So should be easily tradable. Sorry, I shouldn't say property is not tradable, not easily tradable. Okay.
Yeah.
So that portfolio tends to outperform, or rather, on a risk-adjusted basis, which is here risk is measured as volatility. I have a problem with that measure of risk, but nevertheless, that's what people say. But that's not my approach, because I've never been convinced about gold. And I may be, see, I'll tell you about gold. So I disagree with Warren Buffett on this point, at least what is stated of his view of gold in the media. So it comes to me as a second-hand view. I take it with a pinch of salt, because there may be some distortions. But he says that if you put all the gold of the world, then it will occupy a baseball pitch, and then what can you do with it? Just look at it, maybe touch it. Okay. Whereas I carry all this, with the same gold, I can own 100 Exxon Mobils and own all of agricultural land in America and still have some cash in my back pocket to do some other shopping. So I can supply you with all the food and energy needs that you need, right? So yeah, that's fine. But gold is not an asset class. That's my submission.
Okay.
To me, by definition, an asset is something that yields a cash flow. So property is an asset because it yields rent.
Rent, yeah.
Stocks are an asset because it yields dividends. Bonds are an asset because they yield interest, or fixed deposits are an asset because they yield interest.
Yeah.
Gold yields nothing. So gold is not an asset. It should never be compared with stocks. Gold is at best store of value. It used to be a medium of exchange. And you could say it can be used as a unit of accounting. It's a very powerful unit of accounting, which is you should express your wealth in ounces of gold. Like how many ounces of gold you owned in 2000, how many ounces of gold you own today. It's a very reliable unit of accounting. It's better than using currency. But beyond that, gold is not an asset. And this is a similar thing in the current modern world is Bitcoin. Bitcoin is not an asset because Bitcoin yields nothing. Maybe it does in the future.
Yeah.
Bitcoin may start, I don't understand Bitcoin fully, but it may start yielding something, but gold doesn't yield anything. So to my mind, actually, assets are basically bonds, cash, equities, and property. And then, the problem with property is that it is very difficult to trade. And until RERA happened in India, it was not an asset class that, was very
too much
accessible.
Yeah.
And the problem with property is that it's very concentrated, because you can't have a diversified portfolio. You can't own 20 different houses. The ticket sizes are too large, even for the biggest investors. So that's, those are some very big deficiencies in property as an asset class. Cash you should always have, because there's always a rainy day and an attractive opportunity. So I would not dispute that. Why would you own a fixed deposit? And why would you want to own bonds? Because I think you take risk anyway with bonds, and people have learned that the hard way. Companies blow
Unless
up
you're
in
buying treasury bonds of just a risk-free rate, I guess.
Yeah, even that comes with a lot of risk, because at inflection points with interest rate cycles, you get great volatility. You can, of course, hold to maturity, but then will you earn a return which is in excess of inflation? Because if you don't, then you have just reduced your wealth. So when I compare equities with the competing asset classes, I kind of conclude that equities is still the best. Then, of course, there are people who remind me of Japan. And that is one lesson of history that
whether it's the exception or whether it's going to happen again, we don't know. So when you mention this 25, 25, 25, 25, it reminds me of a conversation, and we've, I think, spoken about it in this podcast in the earlier issues as well. Mark Farber mentioned this to us. He said, in his experience, the best allocation is 25, 25, 25, 25. He said 25 real estate, 25 stocks, 25 bullion, 25 cash. I said the equal allocation works the best. Don't try and think around too much. This is what works best for him. And I guess in their case, the real estate is a little more fungible. And probably you can get exposure via proper REITs, if I'm not mistaken. Maybe that's what he meant. He didn't say it, but maybe that's what he meant.
Yeah, but when you buy, so REITs are a proxy for bonds. So you could buy REITs as a proxy for bonds, and then you're buying the same for, right? Then it's the same cockroach portfolio if you're buying REITs. But otherwise, property is a little harder to access in this type of a portfolio.
So you spoke about experiences, right? Wisdom comes from experiences. Tell us one or two such experiences that really had a big impact on your life. Or tell me one, since we're running out of time.
See,
was it meeting Mr. Nimish Kampani in the early 90s and he telling you something? Was it meeting, or what was it?
Again, I'll do injustice to a lot of people who've given me a lot of good advice and wisdom. But out of my own experience, I think two things I'll say. So one is that trading doesn't work. Even though it worked for me, I think it doesn't work. And therefore, you should avoid trading stocks. Stocks are a genuinely long duration asset class. And trading them is exposing yourself to luck, and that will not always come your way. So that's one. And second is that I think after having done this for 35 years, and I'm not being humble at all, I'm being very, very brutally honest, I really don't understand how markets work. They fox me. Yeah, of course, I don't want to say this too loudly because it affects me. But now I'm able to accept this, that I really don't understand, and every market cycle teaches you something along the way. Markets are a highly complex adaptive system, which are constantly evolving. Markets are not a science. Market is not an art. Science, is something which explains. It provides an explanation that is hard to vary and can be falsifiable. This is Karl Popper's definition. Nothing in the market that I understand explains consistently is not hard to vary and is testable. It cannot be falsified. So market is certainly not a science, and it's not an art. Contrary to this popular adage that beauty lies in the eye of the beholder, beauty is actually objective, because 99% of us will find the same things beautiful. Right? And that is why nature is organized around Fibonacci numbers, because it's objective. And the market has nothing to do with art also. It's all psychology. And it's just riding cycles of greed, fear, and hope. And I don't think there's any model in the world that can predict these cycles with any degree of accuracy. So even though I am professionally involved in predicting market cycles, and I do that with great amount of reticence and understanding that I don't understand it.
Awareness,
But I think in the stock market, you only win when you disengage from market cycles and just focus on long-term investing.
Yeah. I really like what you said. You said you don't know how markets work. And I think if you approach the market with that attitude, you get to learn and not make a mistake by making assumptions which may not be valid anymore.
Yeah.
And I think that in itself is a great learning. It gives you an opportunity to just learn more and hopefully take better decisions.
Absolutely.
So there we have it, the secret to Ridham's success.
No,
Right?
there is no secret. I don't know the secret myself. I just think I've been very lucky.
You've been lucky, and you know, you've said some things which are so critical, right? Wisdom comes from experiences. You can read all the books, but value your experiences, learn from them, apply them, and above all, approach the market as if you don't know how it works. I think that's the number one takeaway I have. It'll make you a better investor. Don't make assumptions. So with that, Ridham, thank you very much for talking to us. I'm sorry we exceeded a little bit, but thank you for being patient and answering all our questions and sharing all the great stuff that you did.
Thank you so much for having me. Thank you.
Wonderful. Thank you. Take care.